What's up guys, it's Amos. Welcome back to my YouTube channel. In this video, you will understand a framework on how to read price action. The main problem with ICT traders is that they focus too much on the 1 minute chart and they cannot understand where price is most likely going to go on the higher time frame. In this video, I'm going to show you exactly when to expect reversals, when to expect pullbacks, and what to look for in order to take a trade. I'm going to explain the difference between external range liquidity and internal range liquidity, and I'm going to show you guys 3 entry models that you can take in order to catch those pullback plays. Let's get right into it. The first thing you guys need to understand is that price goes from external range liquidity into internal range liquidity, or from internal range liquidity into external range liquidity. What does that mean? Let's say you have this price action, the buy side liquidity pool and the sell side liquidity pool on the 15-minute chart would be used as your external range liquidity. So this would be ERL and this also would be ERL. But when price takes out a level of external range liquidity, what does that do? It means that price needs to rebalance. It needs to find buyers or sellers to then push price back to the upside or to the downside. So let's use this example. If price goes from external range liquidity into internal range liquidity, that means that if you sweep an external range liquidity, which is a buy side liquidity pool, and you form a fair value gap, that means that price will be attracted to come back towards this fair value gap to fill orders in order to have enough fuel to create new highs. Let's do the bearish example. If you sweep sell side liquidity on the 15-minute chart, it means that you just swept external range liquidity. And if you swept external range liquidity, then price will be attracted to an internal fair value gap, which is internal range liquidity. So right here, as soon as you sweep it, then price will most likely go back to fill orders inside this fair value gap right here to have enough fuel to push price on the way down or up. This strategy right here is called the pullback model. So right here, you only need a sell side liquidity sweep, which act as your external range liquidity on the 15-minute chart. Then you want to make sure that when you swept that sell side, you created a 15-minute bearish fair value gap, which tells you that price displaced towards that sell side, and we then need a healthy retracement because there's a lot of people right here that are willing to get filled on a limit order. Then you want to scale down to the 1-minute chart and find signs of weakness at those lows in order to target this 15-minute bearish fair value gap. Your entry model for this strategy will be either SMT divergence with ES, an inversion fair value gap, an order block, or a breaker block. Then as soon as you have that confirmation, you will want to enter with your stop loss below a swing low for a 1-to-1 risk to reward back towards the internal gap right here. The first entry model we have here is SMT divergence. So ES and NQ are correlated pairs, and when ES makes a lower low and NQ makes a higher low, that means that there's a divergence in the market, which signals a reversal. So in this case, you would wait for ES to create a lower low and NQ to create a higher low, then break structure to the upside, and you would want to take your entry off of the pullback towards this break of structure to then see price go up towards your internal gap. The second entry model we have for this strategy is called the inversion fair value gap. So you can locate a fair value gap by looking at a 3 consecutive bearish candle pattern where the up wick of the third candle does not touch into the down wick of the first. So once you see this, you know that as soon as you close above this fair value gap, you have an inversion fair value gap, which also acts as support. And this is where you would want to take your long entry back into the internal 15-minute gap. The last entry models you can use for this strategy is called the order block and the breaker block. An order block is just a normal breakup structure. So you have a high, a low, and a higher high. And as soon as you have this, you take the last down move before we broke structure to the upside, and this zone right here should act as support in order to create a new high. So if you had an internal bearish fair value gap, then your long entry would be back inside this order block, your stop loss right below this low, targeting the 15-minute gap above you. And what you would need to look for to see a breaker is a bearish order block form, so a break of structure to the downside. So then you would draw this small box right here because this should act as support right here to create new lows if we are truly bearish. But what is going to happen if we're bullish? We're going to disrespect the zone where sellers should have stepped in to defend their position, and we're going to create that low, high, lower low, higher high pattern. And then as soon as you see this, then this neckline right here is where you would want to engage in longs to target your internal 15-minute gap. Let me do a quick recap of everything I just said and all the entry models you can use. So you have the SMT divergence if you have a bullish bias because you swept a sell side liquidity pool on the 15-minute chart and just created a bearish 15-minute fair value gap, this is your drawn liquidity, as you can see right here. So price should be attracted to that 15-minute gap. So what are the kind of confirmations you need to look for on the 1-minute chart in order to take an entry for a 1-to-1 risk to reward? NQ creates a higher low when ES creates a lower low, so that creates a bullish SMT. And as soon as you see that move up in that break of structure, this is where you would want to go long back towards that 15-minute bearish fair value gap. Then let's do the inversion fair value gap. The same thing. As soon as you see that bearish fair value gap formed and then you inverse it, this is where you would want to go long, targeting your bearish 15-minute fair value gap. You also have the order block, which is a normal break of structure. So you have a high, a low, and a higher high. And as soon as you see this towards your jaw, you would wait for price to pull back towards this zone, which is the order block. And then you would take your entry, stop loss right below this low, targeting the 15-minute drawn liquidity. The last entry would be the breaker block, which is a failed bearish order block. Let's say in this case, you create a low, a high, a lower low. So this is your bearish order block. If we're truly bearish, we should respect the zone to create a new low. But if we're bullish and we're getting up towards our drawn liquidity, then we will disrespect that bearish order block, which will create a bullish breaker. And as soon as you have the pullback towards that neckline, this is where you would want to enter, targeting your 15-minute drawn liquidity. Now I want to make sure that you guys understand this model completely, so let me dumb it down by drawing it like I was a baby. So first thing you will look for is that you will go on the 15-minute chart and that you will basically just look for buy side and sell side liquidity pools. All right, so let's say the market trades right here. So if I go on the 15-minute chart, I can draw this high being my buy side liquidity pool and this low being my sell side liquidity pool. As soon as I see this, I know that this buy side is external range liquidity and the sell side is also external range liquidity. So then I would need for us to sweep that buy side or that sell side to then take out that external range liquidity. As soon as I have this, let's say in this case we took out the buy side, then I would be short biased until we feel the internal gap on the 15-minute chart. Let's say we displace up, we sweep that buy side liquidity and we create a bullish 15-minute fair value gap. So then I know price is most likely going to be attracted to that 15-minute bullish fair value gap. So I will then look for signs of weakness at the highs in order to target this internal gap. Let me use a bearish example. We took the shorts here and then price shoots down super aggressively and takes out this low on the 15-minute chart. Then we created a 15-minute bearish fair value gap. If I know we just swept sell side, then I want to target that bearish fair value gap because I know there's a lot of orders right here and price goes from external range liquidity into internal range liquidity. So now I will look for all my entry models to see price pulling back towards the internal gap. So I will be bullish until this bearish 15-minute gap is filled. Now let me show you guys multiple examples of this strategy actually working. So now I'm on the 15-minute chart on the Nasdaq and I can see that we have a swing high right here and a swing low, which would act as my external range liquidity since I'm looking at a 15-minute chart. Now I'm going to wait for price to sweep this high and form a 15-minute bullish fair value gap so I can target it. Right now, we didn't sweep this high yet, but what I'm looking for is to sweep this buy side liquidity pool, then find signs of weakness at those highs in order to draw back towards this internal gap. I want to short towards this internal gap because I know that when we form gaps, this acts as a drawn liquidity on the internal side. This acts as a magnet. So if I know I have a strong drawn liquidity below me because there's a lot of limit orders that buyers are going to put in here, then I want to trade for the pullback play. Now I need to scale down to the 1-minute chart so you guys can see exactly what's happening inside my head when I see this buy side liquidity sweep on the external range liquidity. So we just swept this high right here. So what am I going to use? I'm going to use one of the 4 entry models that I just showed you. So right here, either I would create a breaker block by sweeping this high and then breaking below this low right here. I could create also an inversion fair value gap by creating a new leg with a 1-minute bullish fair value gap that we disrespect. I can also look for a possible short if we have an SMT divergence. Let's say ES goes out and sweep this high by creating a higher high while NQ creates a lower high. So this would be my confirmation that price would possibly reverse back towards the internal gap. Now let me see what we actually get after we sweep this buy side. So right here, we have another sweep of that internal high, and we have a break of structure to the downside. Now we have a possible breaker block opportunity if we can close right below this low, and this is exactly what I want to see. As soon as I close below this low, I have my 1 minute confirmation that is telling me that price is most likely willing to go back towards this 15-minute internal bullish for value gap after sweeping external range liquidity. What will I do next is I will wait for price to pull back into the neckline of this 1 minute breaker, and hopefully if we can see a 1 minute bearish for value gap form, that would be even better. So right now I'm already in this trade right here from the pullback to the neckline, and I will target the internal range liquidity for a 1-to-1 risk to reward. And right here, this is exactly where I would get out of my trade. So we swept the external range liquidity right here, and I know that price is most likely going to go back towards internal range liquidity, which is a 15-minute bullish for value gap. Now you need to look for one of your 4 entry models, and right here we had the breaker block opportunity plus the 1 minute for value gap right here, targeting this 15-minute drawn liquidity. Right here I'm on a 15-minute chart on the Nasdaq, and I can see that we have a buy side liquidity pool just above me. And what happens after is that we sweep this buy side, but we also create a bullish 15-minute fair value gap. Even if I close above this buy side liquidity pool, I just formed a bullish 15-minute fair value gap, so I know this zone right here will most likely act as a magnet because there's so many limit orders and passive buyers ready to get filled to defend their position to create new highs. So I will look for signs of weakness at those highs right here to then see if we can take a possible scalp towards the downside. Now I'm scaling down to the lower time frames to catch a possible entry towards that gap. So I know I'm bearish because I formed a bullish fair value gap just below me after sweeping buy side. So now this is a 2-minute bullish for value gap. We just inversed it by looking at this down close candle. This is where I would go short, my stop loss right above this high, and I would target the unfilled 15-minute fair value gap for a 1.4-to-1 risk to reward. This is where I would put my stop loss. My take profit would be at the gap, and let's look at what happens. And you guys can see in a few minutes you hit your target. Let's get into example number 3. So right here on the 15-minute chart, we have a sell side liquidity pool and a buy side liquidity pool. So right here, if we get below this low, I will look for a possible 15-minute fair value gap, bearish fair value gap to be created, and then signs of weakness at the lows in order to trade back inside the gap. I just scaled down to a 1-minute chart. Let's take a look at what's going to happen once the market opens. So right here, we have sweep of internal lows, and then we have an inversion for value gap pointing towards our unmitigated 15-minute bearish for value gap after sweeping sell side. So now I know this is my confirmation to go long because my drawn liquidity on the lower time frame is the 15-minute gap. So then I will take my position once we can get the pullback towards the inverse to then scalp the move back towards the internal gap. This is where I would take my entry. And as you guys can see, after a few minutes, you hit your target and way more. Let me do a 4th example with y'all. So right here, we have a 15-minute buy side liquidity, which would act as your external range liquidity. Then you would wait for price to sweep this high and form a bullish 15-minute fair value gap. Now that you have this, you want to look for signs of weakness at those highs right here to play the move back towards the 15-minute bullish gap. This is where I would go on the 1-minute chart and look for my possible entry model. So right here we have an internal buy side liquidity sweep and an inverse for value gap on the 1-minute chart. So this would be enough for me to take a short with my stop loss right above this high and target this unmitigated 15-minute bullish for value gap because I know price has more chances of filling the internal gap after sweeping external range liquidity. So this is where I would go short, stop loss right above this high, targeting the unmitigated gap. Let me see how it does. And as you guys can see, in a few minutes you hit your target. Here's another example of this strategy working. So you have a sell side liquidity pool on the 15-minute chart, and you can see that this candle is displacing pretty hard. So if on the next 15-minute we don't trade all the way back here, we will most likely form a 15-minute bearish for value gap. So what do you want to see? You want to see this low get swept, then form this bearish 15-minute gap, and then look for signs of weakness at those lows in order to trade back inside the 15-minute gap. Now let me scale down to a 1-minute chart and see what's the reaction once we sweep this internal low. I will look for possible longs if we can create a bullish structure. So right here we formed a bullish breaker. This is where I would try to take my long, stop loss right below this low, targeting the unfilled 15-minute. If I go to the 15-minute chart right here, this is where I form my 15-minute bearish fair value gap. So after sweeping the sell side liquidity on the 15, this box right here would become my drawn liquidity. I will wait for price to pull back towards the breaker, and this is where I would go in, stop loss right below this low, and I would target the unfilled 15-minute fair value gap. And as you guys can see, in few minutes we hit our target again. Let's do another example. We have a sell side liquidity pool on the 15-minute chart. Then we see that sweep of that sell side liquidity and we form a bearish fair value gap. So this fair value gap would be my drawn liquidity. So now I will need to scale down the 1, 2, 3 minute chart to see if there's any signs of bullishness so I can take longs towards the gap. So now I'm scaling to the 1 minute chart and I'm going to try to take a look at possible opportunities to take longs. So right now price goes up and then goes down to sweep this internal low. And right now I will look for any signs of bullishness. So we have this bearish order block that is formed. So you can see right here we have this block of orders, which is a bearish order block. We created a low, high, lower low. If we are truly bearish, we should respect this zone right here to create new lows. But if we're bullish, we will disrespect it, creating a bullish breaker block towards our drawn liquidity. So if we close above this zone right here, this will be my entry to take longs back towards the 15-minute drawn liquidity. So now we'll wait for price to disrespect the zone, and as soon as I disrespect it, I will take longs back at the neckline, stop loss right below this level, and I will target the unfilled 15-minute bearish fair value gap. So my stop loss would be here, take profit right here. As you guys can see, in a few minutes, you hit your target again. Here's another example. We have a sell side liquidity pool right here. Let's wait for it to get swept. As soon as we sweep it, we form a bearish 15-minute fair value gap. So we swept sell side and we formed an internal 15-minute bearish fair value gap. So this is my setup that is forming. So now I will scale down those lower time frames to see if we have a possible opportunity to scalp back towards this gap. So we'll scale down to a 5-minute chart. As you guys can see, we have a bearish fair value gap that is formed. If we're truly bearish, we should respect this fair value gap to create a new low. But if we're bullish, we will disrespect this gap, creating an inversion fair value gap. And this is where I will take my long entry from. So right here, this is where I disrespect this fair value gap. I will then take longs, stop loss right below this level, targeting the unfilled fair value gap for a 1-to-1 risk to reward. So this is where I would get filled. Stop loss right below this level, take profit right here. And in few minutes, you fill the internal gap and your TP gets hit. Let's do a final example together. So we have a sell side liquidity pool on the 15-minute chart. Once we sweep it, we form a unmitigated 15-minute fair value gap. So since we form a fair value gap, a bearish fair value gap after a sell side liquidity sweep, we know that there's a lot of orders right here ready to get filled. So we then are bullish until this gap gets filled. So this becomes our drawn liquidity. I will scale down to a 1-minute chart and find a reason to enter back towards this gap. So this is a high. If we break above this high, this would become an order block and this could be my entry. So right here, this could be my entry, stop loss right below this low, and I would target this 15-minute fair value gap for a 1-to-1 risk to reward. And as you guys can see, in few minutes, you hit your target again. If you learned something new today, make sure to like this video and subscribe to my channel. If you want to use a prop firm, I suggest you guys go with Tradify. This is by far the best prop firm. Use code AMAS for the biggest discounts ever. Thank you guys so much, and I see you guys on the next one. Peace out.